Chapter 16 of The Intelligent Investor by Benjamin Graham, titled Convertible Issues and Warrants, delves into two complex types of financial instruments: convertible bonds and stock warrants. In this chapter, Graham provides detailed insights into the potential benefits and risks of these instruments, emphasizing that while they may offer attractive opportunities for some investors, they often come with greater risks than more traditional investments such as common stocks or regular bonds. Graham cautions investors to approach these instruments with care, using the same critical analysis and attention to financial fundamentals that they would apply to any other investment. Convertible bonds, a blend of bonds and stocks. Convertible bonds are hybrid securities that combine characteristics of both bonds and stocks. They start out as regular bonds, offering fixed interest payments to investors. However, what sets them apart is the conversion feature. At a predetermined price and time, the bondholder has the right, but not the obligation, to convert the bond into a certain number of shares of the issuing company's stock. This feature provides the bondholder with the potential for capital appreciation if the company's stock price rises significantly. Risk versus reward in convertible bonds. One of the key concerns with convertible bonds, according to Graham, is that they tend to offer lower interest rates than traditional bonds because of the conversion feature. This conversion feature allows the bondholder to convert the bond into a predetermined number of shares of the issuing company's stock. While this can be an attractive option, it comes with its own set of risks and rewards. Essentially, the investor is sacrificing some interest income in exchange for the opportunity to convert the bond into stock and benefit from any increase in the company's stock price. This potential for capital appreciation can be very appealing, especially in a bullish market where stock prices are expected to rise. However, it's important to remember that this is not guaranteed. This trade-off can backfire if the company's stock price does not rise, leaving the investor with a bond that pays below market interest rates and offers little prospect of capital appreciation. In a worst-case scenario, the stock price could even decline, making the conversion option worthless and leaving the investor with a low-yield bond. Additionally, if the company's financial position worsens, the value of both the bond and the stock can decline, leaving the investor with losses on both fronts. This dual risk is something that potential investors need to carefully consider. Convertible bonds can be a double-edged sword, offering the potential for higher returns, but also exposing the investor to greater risks. Therefore, it's crucial to thoroughly analyze the issuing company's financial health and market conditions before investing in convertible bonds. Key factors to consider. Graham outlines several factors that investors should consider when evaluating a convertible bond. These factors are crucial in making informed investment decisions and ensuring that the potential benefits outweigh the risks. 1. The company's financial health. This is a fundamental aspect that cannot be overlooked. Just as with any other security, investors should evaluate the financial stability of the company issuing the convertible bond. This involves a thorough analysis of the company's balance sheet, income statement, and cash flow statement. Graham advises looking at key financial metrics such as debt levels, earnings stability, and the company's ability to generate cash flow. High debt levels can be a red flag, while consistent earnings and strong cash flow are positive indicators. 2. The conversion terms. The terms of the conversion are critical. These terms dictate how and when the bond can be converted into stock, and they can significantly impact the bond's attractiveness. Investors should pay close attention to the conversion price and how it compares to the current stock price. The conversion price is the price at which the bond can be converted into shares of the issuing company. If the conversion price is too high relative to the stock price, the bondholder is unlikely to benefit from the conversion feature. Therefore, understanding the conversion terms and how they align with the current market conditions is essential for making a sound investment decision. Warrants. Leveraging potential gains with high risk. A warrant is another financial instrument discussed by Graham in this chapter. Like a stock option, a warrant gives the holder the right to purchase a company's stock at a specific price, known as the exercise price, within a certain time frame. Unlike convertible bonds, which are debt instruments, warrants are often issued alongside bonds or preferred stock as a sweetener to make the offering more attractive to investors. Risks associated with warrants. Warrants are appealing to some investors because they offer the potential for leveraged returns. Since warrants are generally much cheaper than the underlying stock, an investor can control a large number of shares for a relatively small investment. If the stock price rises, the return on the warrant can be many times greater than the return on the stock itself. However, this leverage also works in reverse. If the stock price does not rise, the entire investment in the warrant can be lost. Convertible bonds and warrants in a defensive portfolio. For defensive investors, Graham's advice is clear: approach convertible bonds and warrants with extreme caution. While these instruments can offer the potential for higher returns, they also come with significant risks that are often not fully appreciated by investors. In the case of convertible bonds, the defensive investor should only consider them if the issuing company is financially strong and the conversion terms are favorable. Convertible bonds and the efficient market hypothesis. Graham's analysis of convertible bonds and warrants is rooted in his broader investment philosophy, which emphasizes the importance of focusing on intrinsic value and avoiding speculative behavior. He notes that many investors are drawn to these instruments because they offer the potential for large gains, but he cautions that such potential often comes at the expense of higher risk and greater uncertainty. A conclusion. In Chapter 16, Graham provides a thorough analysis of convertible bonds and warrants, delving into their intricate structures and the unique opportunities they present for investors. He highlights both their potential benefits and risks, emphasizing the importance of understanding these financial instruments before making any investment decisions. While these instruments may offer attractive opportunities for more aggressive investors looking to capitalize on market movements, they are generally unsuitable for the defensive investor who prioritizes safety and stability. Defensive investors should be wary of the volatility and potential downsides. Graham's key message is that investors should apply the same rigorous analysis to convertible bonds and warrants as they would to any other investment, ensuring they fully understand the implications. This includes focusing on the financial health of the issuing company, scrutinizing their balance sheets, income statements, and overall market position. Investors should also carefully examine the terms of the security, including conversion rates, maturity dates, and any clauses that might affect the investment's value. Additionally, understanding the potential risks involved is crucial. This means assessing market conditions, interest rate fluctuations, and the specific risks associated with the issuing company. For defensive investors, the allure of convertible bonds and warrants may be tempting due to their potential for higher returns, but Graham's advice is to proceed with caution. He suggests that defensive investors should only consider these instruments if they have a thorough understanding and are prepared for the associated risks. Ultimately, Graham's insights remind us that a disciplined and informed approach is essential in navigating the complexities of the financial markets, ensuring that investment decisions align with one's risk tolerance and financial goals.
Thank you for watching. Share this with friends and family, and please subscribe.